Wall Street was on fire in January 2021, and the short squeeze of GameStop made its way to the White House and the desks of politicians like AOC Ilhan Omar and Ted Cruz. But what happened? Why did it happen? And what are the ramifications for the trading industry? Back in September of 2019, Keith Gill, also known as Deep Fucking Value on Reddit, posted on Wall Street Bets, a Reddit forum with over 1 million members at the time, that he had invested an initial amount of $10,000 in GameStop stocks. He felt that GameStop was undervalued, had suffered from being sold off unfairly, and that Wall Street was discounting the possibility of the company turning around.
GameStop is an established, uniquely positioned player in a thriving $150 billion gaming industry. And this is why GameStop is different. Its final puff is a legitimate opportunity to reinvent itself as a premier gaming hub.
He did, however, warn his viewers that this investment was a YOLO trade and required diamond hands. YOLO refers to a high-risk investment, and having diamond hands means you are willing to hold the stock despite enormous risk and volatility. Was Gill crazy for this trade?
But cheers to Ryan Cohen! Cheers to Ryan Cohen! This is sick! This is hilarious, right? This guy's the man. Oh my, this is incredible!
Well, not really. Wall Street veterans such as Michael Burry, the original Big Short investor, and activist investor Ryan Cohen also purchased billions in GameStop shares. On January 11th, GameStop named new board members to help with both its online transition and its accelerating digital sales. This created a feeding frenzy of Wall Street bettors and other hedge funds buying the stock. But what really fueled the fire was a January the 21st video of Andrew Left mocking people on Reddit and Twitter for buying GameStop and predicting how they are going to lose everything they have.
Numbers don't lie. People lie. I know everyone on Twitter never has a losing trade. Everyone on Reddit is a market genius. I hear it all the time.
Messages of buy and hold then started circulating on Reddit and Twitter, and many well-known investors, including Chamath Palihapitiya and Elon Musk, took the opportunity to show off their GameStop purchases. Subsequently, the stock surged over 1,600%. And the result? GameStop squeezed to over $500. Melvin Capital lost over $4 billion. Andrew Left publicly announced that he had closed out his position. Citadel, one of the main clearing firms on Wall Street, came to the rescue of the short sellers, and Robinhood and a few other brokers stopped retail traders from buying GameStop.
Will you admit that the tens of millions of people that had their hard-earned money inside of Robinhood was prevented from participating in trades that could have been executed other places because of an arbitrary decision by Robinhood that they ended up making?
After the halt of GameStop sales on Robinhood, the FTC, Federal Trade Commission, received complaint after complaint after complaint regarding Robinhood's actions in preventing its users from leaving the app, while the Google Play Store was flooded with so many one-star ratings for the Robinhood app, the app's rating fell to 1.2 stars. It was revealed during hearings in the U.S. Congress that Robinhood was required to deposit money to its clearinghouse in order to meet its daily transaction demands. Despite the $3 billion received from Citadel and evidence of the surge in demand for GameStop between January 11th and the 27th, Robinhood had in fact failed to raise the required amount of capital to avoid illiquidity. When Robinhood CEO Vlad Tenev was asked about having sufficient cash on hand to meet its capital requirements during the fever pitch day of January 28th, he responded,
"At that moment, we would not have been able to post the $3 billion in collateral."
Tenev had earlier claimed that Robinhood had no liquidity problems. He said Robinhood managed to raise $1 billion in an emergency funding round, and that it was able to calm its clearinghouse by limiting the volume of meme stocks being bought on its platform, eventually paying about $700 million to settle the matter. Nevertheless, moving past the drama, what happened on GameStop will impact the stock market, for better or worse, for generations to come. Love it or hate it, retail investing has been affected by these events, and now, not too many days after the first hearing at the U.S. Congress, changes are already afoot. There is talk about more transparency regarding payments for order flows, shorter settlements of T+1, or even perhaps in real time, implementation of a Wall Street Tax Act for 2021, imposing taxes on high-frequency trading, more restrictions for options trading depending on the level of sophistication of the trader, minimizing gambling, gamification, and addictive trading behaviors with the help of AI, and creating a more level playing field for Wall Street and Main Street investors. Given all that's unfolded, now is a good time to ask these two questions. Who is the real customer of companies like Robinhood, and what, or more precisely, who is the product? Can Robinhood survive this scandal? Will it have a successful IPO? Only time will tell.